stop what you're doing. Seriously. Because if you own Liquidia stock, or honestly, if you're even just thinking about buying into the biotech sector right now, you need to see this 5-model valuation breakdown. Last week, I ran Liquidia through 5 distinct fundamental models, plus 2 legendary investor checklists. And man, what I found shocked me. I mean, did you know a company's revenue can jump over 4,000% in a single year, yet its intrinsic value is still completely heavily debated just because of a sudden courtroom battle? It hits on this super common fear for retail investors, right? You know the one. You find what looks like an absolute hypergrowth rocket ship, only to constantly worry that a massive debt load or some lawsuit from out of nowhere is just going to blow the whole thing up. It is the classic trap. So today, we're cutting through the noise and applying strict fundamental analysis to all this chaos.
And look, by the end of this explainer, you'll have a clear, actionable framework that you can literally steal for your own portfolio. You'll know exactly if Liquidia is a Warren Buffett moat buy or if it's a classic Peter Lynch worse-than-it-looks trap. I want to start right here because this number, this is the gravity center of our entire fundamental analysis. 4,187.1%. Let that sink in. That is Liquidia's staggering year-over-year revenue increase for the very first quarter of 2026. They reported total revenue of $132.87 million, just absolutely shattering consensus estimates. To put that into perspective, it's kind of like a tiny regional indie brand suddenly capturing the market share of a massive global monopoly literally overnight. When you see a number like this, we're not talking about organic, incremental growth anymore. This is a seismic shift in a company's fundamental business model. But the real question is, does this top-line explosion actually pass the strict parameters of the Buffett and Lynch tests? Well, let's dig in and find out.
Okay, let's dive into Section 1, the YUTREPIA revenue boom.
So this bar chart really tells the story of one of the most aggressive product ramp-ups we've seen in the biotech space recently. We're talking about YUTREPIA. It's an inhaled, dry powder formulation of treprostinil, which is used to treat pulmonary arterial hypertension. It got full FDA approval back in May of 2025. Just look at the velocity here. In Q3 2025, right after the launch, they hit $51.7 million in net product sales. Fast forward to Q4, and boom, that jumps to $90.1 million. And now, Q1 2026, they've hit $129.9 million. So what's actually driving this? Well, the sources show that since launch, they've seen over 4,500 unique patient prescriptions, and they've successfully treated around 3,750 patients. The market adoption here is crystal clear, and that quarter-over-quarter growth is just incredibly steep.
But hey, top-line revenue is great and all, but as we know, it's the bottom line that actually keeps the lights on, right? Well, that $129.9 million in product sales translated into a massive $52.9 million in net income for the quarter. That means Liquidia has now delivered its 3rd consecutive quarter of true profitability since the YUTREPIA launch. We are looking at an earnings per share of 52 cents, which comfortably beat the 41-cent consensus estimate. When a company manages to transition from a cash-burning clinical stage biotech into a profitable self-funded commercial business, I mean, it fundamentally changes how the market values them.
Moving right along to Section 2, financials, profits versus debt.
And this brilliantly illustrates the exact tension I was talking about earlier. On the left side, things look fantastic. Thanks to that YUTREPIA boom, Liquidia grew its cash and cash equivalents to a really healthy $222.8 million by the end of March 2026. That is up over $30 million from just the previous quarter. But then you look at the right side. You see the anchor that's kind of weighing them down, a total debt load of $199.18 million. Financial analysts describe this sort of foundation as risky but improving, because having nearly $200 million in debt means they are heavily leveraged, and servicing that kind of debt requires some serious sustained cash flow.
Which brings us to the cash flow itself. Now, despite the massive net income on paper, from a pure cash flow perspective, Liquidia's operations are technically still burning cash. In the most recent quarter, their operating cash flow was negative $9.77 million. But, context is absolutely everything here. That is a huge improvement from the negative $39.48 million they burned in the quarter right before that. So the burn rate is shrinking drastically as those revenues scale up. Financial analysis from our sources points out that with their current cash reserves and this much improved burn rate, Liquidia has roughly a 1.5-year runway. That is an absolutely crucial window. They have to maintain their launch momentum and flip that operating cash flow into the green before that debt becomes an unmanageable burden.
Now for the complicated part. Section 3, the patent war context.
So Liquidia is currently locked in this really dense, high-stakes patent war with an industry giant, United Therapeutics. See, United Therapeutics makes a competing drug called Tyvaso, and they sue Liquidia claiming that YUTREPIA infringes on multiple patents related to their drug delivery technology. Now, Liquidia actually scored a massive victory recently. You'll notice the critical 793 patent, which was basically central to the whole case, was actually invalidated by the Patent Trial and Appeal Board. I mean, that was a huge win for them. However, the threat isn't totally gone. United Therapeutics is still pushing for injunctive relief in the courts. If they are ultimately successful in getting an injunction, it could literally block Liquidia from selling YUTREPIA altogether. It is basically a sword of Damocles hanging directly over that $129.9 million revenue stream we just talked about.
Let's wrap up the data with Section 4, Analysts and Smart Money.
It is super clear that Wall Street analysts have turned highly bullish following this Q1 earnings beat. I mean, look at this. We've got Needham raising their price target to $70 with a buy rating. Wells Fargo rates it overweight with a $62 target, and BTIG has a buy rating sitting at $59. The consensus among the 12 analysts covering the stock right now is a moderate buy. They are clearly looking at that YUTREPIA growth curve and betting that Liquidia is going to successfully navigate all those legal hurdles and just outgrow its debt.
Now, what's really interesting about this slide is the divergence in behavior between large institutions and the company's own insiders. Look on the left. Institutional buying is incredibly aggressive right now. Farallon Capital Management, for instance, boosted its position by a staggering 102%, grabbing over 4.3 million additional shares. Major players like BlackRock and Vanguard hold massive positions too. Overall, institutions own roughly 64% of the stock. But look over at the right side. We're seeing some notable insider selling. CEO Roger Jeffs recently sold over 32,000 shares, and director Stephen Bloch sold over 62,000 shares. Now, to be totally fair and completely impartial here, our sources do note that these sales were executed under prearranged 10b5-1 trading plans. Those are often used just to cover tax obligations on vested equity, so it's not necessarily a panic sell. Actually, scratch that, it's totally standard practice. But still, seeing executives take some profits off the table while institutions are busy loading up the boat, it definitely creates a fascinating mix of signals for anyone watching this company.
Which leaves us with this final thought. Liquidia is a company fundamentally transformed, boasting over 4,000% revenue growth and genuine profitability, all thanks to YUTREPIA. Yet they are still navigating a pretty heavily leveraged balance sheet and fighting off an absolute titan in court just to keep their product on the market. We've laid out the data from the sources, but ultimately it's up to you to weigh the evidence. Has this biotech firm finally reached its permanent turning point, earning that coveted Buffett stamp of approval? Or is the risk of a Lynch-style trap still just a little too high? It's a classic market standoff, and for sure, one that is absolutely fascinating to watch unfold. Thanks for joining me on this deep dive, and I'll see you in the next explainer.